Alrighty guys, what is going up? Welcome back to the best investing money management channel on YouTube. In today's video, we are going to be talking about, is Tesla overvalued and due for a crash, right? We all know Tesla has pretty much had a amazing month. If we actually look at the chart here, you can see the past 20 days has been an absolute powerhouse. This stock has gone from lows at $783 all the way up to $1,250. That's a 60% return in 20 days. For a company of this size, it's crazy. So a lot of people right now are saying, Carter, can the momentum continue? And I do think there is a lot of opportunity on the long, and right now there could be a little bit of an opportunity on a short side. But let's talk about it. So why is Tesla going up so much so fast? Well, they secured a 100,000 order from Hertz. They released earnings and blew their earnings out of the water. So you can see they released earnings after hours right here. And then ever since, we've had a amazing return. In literally a couple of days, in 3 days, we had a return of about 20% of value, which took up a huge chunk of this run. And then even the following day, it went up 27%. So you can see just in a matter of a couple days after they released that earnings, they had an amazing couple of days. And even if you would have just bought in on the earnings or right after, you're up handsomely right now. And anytime a stock just continues to work its way up, a lot of people always think, well, Carter, it's due for a sell-off, it's due for a crash. Well, is it due for a crash? Me personally, I do think we'll see some sell-off of Tesla. I think we'll see the stock fall back down about this $1,000 mark. And that's only going to be a fall of about 10%. And for a company that went up 60% in 20 days, 10% is pretty much just cooling off, allowing all the investors to kind of relax, some people to sell some shares and make some profit, all of that stuff. And then I think we're going to find some support near and around that 200 moving average line. So this yellow line, I think it's going to represent a very, very strong support. It represents one in the past. You can see it hits it several times right in here, and we get buying pressure every single time there. But look at this. Okay, the most important thing when you evaluate a stock is getting in overvalued. That's like one of the worst things you can do. You could be right on the stock, but if you're bought, at all-time highs, that's not a good thing for a short-term investment. Long-term really doesn't matter. You always want to obviously try to get in on the lowest price. But looking at this right here, this down here is the RSI. So this represents the relative strength index. So when it's overvalued or it's up right in here, you can see we have this tendency to see sell-off shortly after, right? It hits this red several times, and then we see a sell-off shortly after. And now when we actually look at it all the way up in here, you can see it's actually trading way higher than it previously has ever traded at an 85 on the RSI. So yes, I do think we'll see some sell-off back down to about a 60 or 70 on the RSI before we see some support. So that's going to put it right at about that $1,000 mark. And I think that's going to be a strong suit to buy in. Now, should you buy it right now? I think that's always a common question, we get asked is, Carter, should I buy this? The stock has gone up 60% of value. Did I already miss the train? Did the train already leave the station for me? Should I just hold off? Well, I think it all depends on your investment, right? So if you're a short-term, swing trader, I think it's better to wait. But if you're a long-term investor, I think what I would recommend doing is dollar cost averaging. So really what you do is, if that's just say you want to invest $1,000 total into Tesla, instead of putting up that $1,000 right now and have it be overvalued on the RSI, what you do is you actually spread it out into weekly or monthly payments. So you still invest $1,000, but you spread it out. So you either invest once a week, once a month, whatever you choose. And so maybe you'll invest $100 a week over the next 10 weeks. So during that 10-week span, you're going to get a good average price for your shares. So the beauty of it is, if we look back in history, and this is very similar to like the chart now, if you're buying in, okay, all you're doing is you're just averaging your shares in, okay? Now the beauty of it, the beauty of this strategy is when it sells off, just like it does in here, you're continuing your investment. Okay, so you're averaging your shares down, and now your average shares are going to be extremely low. So when the stock turns around and recovers, you're going to be making a lot more money because your average shares are going to be so low. So this is a fantastic strategy for this stock in general, and in a lot of growth stocks, just because of the volatility that it brings. You use it to your advantage. Not to mention the little twist that I always recommend doing is anytime it really falls more than 6% of value in more than a week, I double what I normally will put in. So right in here where we had these crazy sell-offs, instead of putting $100 in, I will put $200 in it and then get my average share extremely low. So once it recovers, you're making a lot more money. It's a beautiful way to invest. I always highly recommend it. And Tesla is due for not a crash, but a correction, maybe a 10% fall. A crash is when a stock falls more than 20%. So I don't think we're due for a crash, maybe a little bit of correction to have the stock kind of cool off just because of the overall growth we've seen from it. So guys, I hope you guys enjoyed it. If you did, hit that like button, subscribe to the channel, and we will see you guys later. Remember to stay happy, stay positive, and stay safe. Take care.